comes in as you see. We started the morning when we talk about the market, and then we went over general trends, investment, how regulators and others can come in on a startup story. And we saw the market and policy, and really we saw kind of that higher level. And so then without the startups, there is no market. So now when we talk about this in this next panel, let's focus on liquidation, building to exit. We have the founder perspective, a female perspective, which we as Ignite the Spark always support, especially with our women in energy community. We have the investor perspective and the commercialization focused on deep tech and hardware challenges. I want to invite up Danny Ackerman, co-founder and managing partner at Key One Capital, Dr. Noah Rushin-Rimini, founder and CEO at Grid4C, which was recently acquired, Shahar Levy, co-founder and CEO at Locust View, and this is going to be moderated by our very own, the glue behind the scenes, Aya Frati, Strategic Partnerships Manager, Ignite the Spark. The mics. No. Yeah.
Okay, so we have very short time, and I see the timer is already running, but we might steal a few moments more to tell the story of 3 very unique exits. We have 2 founders that built for 13 years or so, and 1 investor who came in about 4 months before one of the biggest exits of this year. And I'll let you introduce yourselves very quickly. And please give us your perspective. We called this a build to exit panel. So we want to give these people a taste in just the short time that we have of the story from build to exit, the most interesting thing that happened. And that's how you'll introduce yourself.
Hello, everyone. Good to see you. My name is Shachar Levy, the co-founder and CEO of Locust View. We've been acquired by Itron. It's an American company. The deal was closed in January of this year. They bought us for $525 million, all cash deal. And actually, we have a long story. I don't know if we can do it, but I try to do my best. Or at least if I'm looking at the people here at the audience, I would speak maybe about a few things that have made us successful. Or at the end of the day, what are the things that we did differently that helped us to be successful at a relatively short period of time and to get a substantial result, both for us, for our employees, and for the shareholders. The first thing that have made us successful is the focus and being buying for the industry. If you think about the startup community here in Israel, you know, it might be cyber or consumers, you name it, but when you think about energy, it's different. You need to understand the industry. You need obviously to have real problem. You need to have a technology that can solve it. But what you need more than anything, you need access to the market, and you need the utility customers or whomever you are selling to have the confidence in you and to be able to take it from the pilot phase and proof of concept and so on into commercialization. And I think that in this case, in our case, our ability to show that we have built our technology by and for the industry is what have made us successful. Now, what does it mean? What does it mean to get it to a point that customers, in our case, the largest utilities in the US, think that this is almost their solution, which will, at the end of the day, will help you to buy, for them to buy it and so on. So a few words about what we did. We built a platform that helps some of the largest utilities in the US to manage their construction process end to end, all the way from the planning, design, execution, build out, and the closeout of the project, and pretty much putting gas into the pipe or electrifying the grid and so on. And it's a big market. When we started the business 11 years ago, we didn't know that we'll have all the boom in data centers and AI. Back then, I was thinking mainly about replacing old leaked pipes or even maybe charging electric cars and such, but definitely not the boom that we have seen in the industry over the last 2 years. And it was very clear to me that if you want to scale, if you want to build the infrastructure and to do it in a fast and efficient manner, you need technology. Now, okay, you have an idea, you understand that there is something here, but how do you get from there from building a product? And as I said, make it a product for the industry. So the industry will feel that it's theirs and so on. In my case, we had collaboration with the Energy Technology Institute in Chicago, and it was amazing. It was amazing because they gave us what you need, and this is the access to market. So we came, myself and the team from Israel, that coming from the tech and business point of view and obviously perspective, we came with a solution, but it's not enough. You are going to the largest utility in the US, tens of billions of dollars worth of companies, and you want to offer them the technology. Why would they buy it? In our case, our ability to work with GTI in the early days of the company, for them to open us the door, sit in a room and tell, okay, test it, give us the stamp that you need, which at the end of the day will give you the opportunity to prove your technology, was something very unique. And once we went through this phase, meaning, okay, they are good, they are valid, let's see what they have, we build the technology with them. The largest utility in the US, as I said, have seen it as their own solution, meaning it's something that will help them to grow their business, will help them to build their infrastructure. And it was, from this point, it was an amazing runway, and that's it. I could speak more about it, but it's right.
Of course. Well, I think that Noah has a similar but different story, so maybe we can hear what you think is how your journey
more
is different or
than
different.
similar,
Yeah.
I think. Yeah. So a little bit about my background. I have a PhD in AI and machine learning, so I don't come from the energy industry. From the Faculty of Engineering in Tel Aviv University. And I founded the company back in 2013 when I learned that there are millions of electric smart meters deployed all over the world. There's more than a billion today. And I tried to figure out how I can apply AI to the vast amount of data coming from these smart meters in order to improve energy efficiency, to optimize the electric grid, to unlock grid flexibility. So, I mean, fast forward, overall, we've raised $13 million from strategic investors, which is a really important thing to have in our industry. And maybe I'll talk about it later.
We'll touch on that as well.
Yeah? Okay. So I'll talk about it later. But the one big challenge that I discovered pretty quickly was the long sales cycle. The energy industry is heavily regulated. And if you want to sell solutions to utilities, the sales cycles can take between 1 to 2 years. And that's a big issue when you're a startup and you're burning money. And the way I chose to tackle that challenge was, one, to focus on the deregulated market for starts in the US. I moved with my family to live in Texas, and there's a deregulated market. They're competing with each other. They need to be innovative, and that's why the sales cycle is much shorter there. So very soon, they were all hungry to understand there was no AI hype back in 2013. I remember my first interview, I was asked, why should utilities care about AI? So I needed to educate the market, and in the deregulated market, they were hungry to implement our solutions. So that was one way to tackle that. And the second way was to partner with other companies that work with utilities so we could scale fast. Those partnerships, like companies like smart meters companies like Itron and Landis+Gyr, Gear, energy efficiency companies, and also other technology companies which had complementary solutions. And one of those companies initially acquired us. So that's kind of in a nutshell.
Thank you. And Danny, you have a bit of a different story from the two very energy-focused entrepreneurs that we have. Tell us a little bit about Key One and how you found yourself investing in Dust Photonics.
Sure. Hi, everyone. Danny Ackerman. I'm one of the co-founders of Key One Capital, which is a growth fund, $300 million. Myself and two of my co-founders, we spent the vast majority of our careers at Goldman Sachs before founding Key One. So again, $300 million growth fund, investing across the board, but mainly in infrastructure, AI-related type investments, cyber, a little bit of consumer. So Dust Photonics, we've known Dust for a number of years. We didn't invest the first time they came to us. By way of background, what they do is optical technology for data centers. Data centers are transitioning slowly from copper based technology to optics, to increase throughput relevant for energy consumption, to reduce energy consumption, which is scarce. And when they initially came to us a couple of years ago, the technology wasn't kind of fully baked, and they did change the technology configuration. They started with transceivers, very difficult competition against the Chinese players, and then ultimately decided to morph into developing one specific, very important element inside that transceiver piece, which is basically the component that transmits kind of electronic signals to optical signals in the data center. So you can just imagine with the wave of data center build-outs, their technology became more and more front and center. So lesson number one from this whole thing, before I'm getting to the exit, is you have to be super versatile in making the right call at the right time to switch technology. Also augment the management team, which was done quite successfully. Obviously, no credit to us in that regard, but the company was followed, founded, and chaired by Avigdor Vilens, who many of you, I'm sure you know. He's one of the founding fathers of semiconductor in Israel and globally. So that's kind of lesson number one. When you need to switch, do it. When you need to do it, kind of do it at the right time. And if you don't do it, the penalty can be just going out of business. So they successfully done it. Lesson number one. Lesson number two is to know when to sell and when to exit. Now, we invested in them. We invested in them in December. Shortly thereafter, they received an acquisition proposal from a company called Credo Public Company that's actually in the copper business, needing the transition to optical. And arguably, you could have run with standalone kind of mode for a while. And you don't have an A/B testing what happens if you don't sell. But knowing how to map out the landscape of potential buyers, and again, the credit goes to Avigdor in that regard, on balance to say, listen, this is the right acquirer. And by the way, a portion of the consideration, so we invested, it wasn't published, but we invested a few $100 million valuation, the base deal $1.2 billion, but there is a considerable component of equity of the acquirer, and the equity, the stock price of the acquirer doubled over the last month. So that portion now, so the 1.2 is worth more like, I think, 1.6. But, and that's the other lesson, is to understand the value of synergies. The market, when they saw that combination of copper-based, publicly traded company with a leading optical private company, the stock, the day of the announcement, jumped by 20%. So Credo went from 25 billion to 30 billion. So 5 billion in value for an acquisition of about 1.2 billion in one day, and since then they kept climbing.
Amazing. And I think this is something that we really want to touch on. Knowing when to say yes, knowing when to say no, knowing when to say and who to say yes and who to say no to. And I think that's something that both of you, a couple of times over the many years, found yourself in positions of saying both no and yes. So maybe tell us and tell the people in the room, we have some founders here as well, who should you be taking money from and when?
So as a company that said yes to strategic investors, I think I would kind of categorize strategic investors to three different categories. There are the VCs that are backed by many utilities, by leading utilities. In my eyes, they are the best investors to have. We had Israel Cleantech Venture. Today they're called More VC, and I think I saw Jack Levy in the audience. And so they led our first round. The advantage or of having such an investor is that they open doors for you. They can push you. They can arrange meetings for you with executives and utilities, and they can give you that edge in the procuring process. So it's a huge thing to have. The second part, and that's a utility VC. So it's the funding part of a specific utility. The advantage is that it kind of validates your technology. It signals to other utilities that you have a valid technology that the utilities need. There is a downside to it. And another advantage, of course, is they can be a customer, so you can generate revenue from them. Unfortunately, what we found out, and I think it's pretty common, is that you still have to go through the 1 year, 2 year procurement process. Also, one hand funds you and gives you money on Monday, and then on Tuesday, the procurement team will kind of let you go through those 2 years of sales cycle in order to sell. In our case, it was Electra Utilities. It's one of the biggest or leading utilities in Canada, and they led our second round. So, and the third type is another technology company that sells to utilities, like Itron, like Landis+Gyr Gear. The advantage there is they can help you scale quickly. They can potentially acquire you at a certain stage, like what happened to Shachar. But the downside is that it kind of limits your market because it's going to be difficult for you to collaborate or partner with their competitors. I've been following since Landis+Gyr invested in them in 2019, and only to embed their technology inside Landis+Gyr's smart meters. And only 4 years later, they announced a partnership with Landis+Gyr's competitors, with Itron. So to your question, you ask about acquisition, you get, you kind of are in a process of selling the company all the time. Those, those processes, you have to, it's like you have to run the company like this is not happening. You need to run the company to be profitable. But in parallel, you have to run these processes. Companies approach you, your customers, your partners try to acquire you. Sometimes the timing is not good enough. Sometimes the valuation is not good enough and you feel like you can do better. Sometimes the chemistry is not good enough, which is also important. Sometimes there is no trust. So a lot of things to consider.
I think, Shachar, this is maybe your time to tell the story of the rocket that saved your...
No, the rocket, but I would say a few things here. First, it's not only who to take money from, but when, and I will explain. Because maybe sometimes the best partner that you will have in the early days of the company might not be the right one when you want to scale. And it's actually happened to us. Going back to what I said before, we had GTI in the early days that helped. It's a non-for-profit organization owned by the largest utilities in the US. Obviously, as I said before, it was a great partner for us, and we had a joint venture with them to help to build the technology and improve it. So we did it between 2014 to 2018. But then at this point in 2018, we had a great joint venture. We were ready to take the company to the next level, meaning to scale the business, start to sell it at scale and so on. And suddenly, the partner that helped me in the early days to prove the product between 2014 and 2018, it's not the right one now scaling the business because they are non-for-profit and so on. And at this point, I needed to take a hard decision to raise money from, in this case, friends and family, because this was our first real seed fund, and buy out GTI, this non-for-profit organization. Why? Because I understood that in the early days, they were a great partner, but if they will stay on the cap table, they will now hurt my ability to scale. So as I said, we did this transaction. They got what they need, which is a good proof of concept and good signal for the industry. And from that point, I could now take the company and grow it. So again, this is an example of sometimes you need a partner. You can take money from someone for a certain purpose, but it's also okay if you think that now you're getting to a different stage, and in this stage you need someone else to find the commercial way to separate ways and move forward. So this is one. The second thing is to decide, and you touched on it, is who you take money from. You mentioned the corporate, the utility corporate money or any of the impact partners, and there are few funds that are focusing on the industry, and it has pros and cons, and as you said, but there is also a decision that you need to make what is good for your business, and I will explain. For us, at this point, when 2021, we did our growth round, we ended up raising 64 million from Israel Growth Partner, and why we did it, why we had also offers from all the companies and the funds that was mentioned here, is because you need to understand what is missing for you. For us, at this point, when we went for the growth round in 2021, we already had a recognition in the market. We needed now a partner that will help us to scale. For me, it was the first time that I built a startup, a software company, how you do, what is the go-to market, and so on. It was less about help me to bring my brand to the US market, which is where we sold our solution, but it's more about help me to understand what it means to build now a software company and to scale and to take it from 5 million to 50 million revenue, whatever. And in this case, for me, to pay the tax that comes with if you are taking someone from the industry, as it was mentioned before, it isn't worth it because I already had reputation. So this is why I'd prefer to go someone who's going to the scale. Now, again, going back to the exit, at this point we need to take a decision. Are we going to do another round or we are going with strategic? At this point for us, there was a lot of, we don't have a lot of time to speak about it, but the bottom line for us with the AI and everything that's happening on the market, we understood that with Itron we can now take what we've done at a very nice scale and take it to a completely different level. They're acting in 100 countries, and it's why we went with them.
Thank you. So we will wrap up, but I do want to hear Danny's perspective from the investor side quickly before we do our last words on how you look at the cap table when you see these types of strategic investors. Is it something that is worrying for you as an investor of a different type, or is it something that gives you validation for the company?
So oftentimes it's very helpful because those strategics, when they come in, they have clauses of right of first notice, right of first refusal. So it's validating that they entered. Some of them just enter in order not to miss something. And oftentimes they're just at the cap table and they're silent and they're not that active. And maybe when they invested it was strategic and now it's not. But more often than not, it's helpful in validating at the entry and serving as a potential party that can buy the company later on. So for instance, when I was at Goldman and we helped sell Habana Labs to Intel, the important part was that Samsung was in a cap table, they got the notice, they submitted a competing bid, it helped keep Intel kind of on their toes. So just from a tactics perspective, from a pure M&A perspective, I think it's helpful to have them in. They can also help. But it can be a double-edged sword because if they got in a certain round and then they're not re-apping or participating, you can ask yourself the question, are they disappointed? Maybe they're off to something else. They might have invested in somebody else. So it can come in different flavors. Each has a kind of different angle. So you need to weigh carefully who you get into your cap table, how they behave afterwards. But I think on balance it's positive. But don't let, they cannot pierce a certain percentage holding such that your company is being colored in a certain color by somebody that said, well, the other ones are not going to submit a bid because it's quite clear that this one sitting in the cap table is the buyer.
Yeah. So I think we'll leave with one word from each, one sentence from each, a tip for our investors and entrepreneurs in the room from each of you, one thing that you want to leave them with, or maybe just a trend that you see where you think the next big thing is going to happen in energy tech.
Next thing is definitely happening with data centers. And the one tip that I was surprised that Shachar didn't take, but for me, I wish someone gave me that advice, was, regulatory expertise is super important. So either work with lobbyists or hire a head of regulatory affairs. But I think there's a very important, probably not enough time to talk about the case study of Opower that were eventually acquired by Oracle. But what they did was fascinating. And in one sentence, they hired lobbyists that were able to persuade regulators to require utilities to launch energy efficiency programs. And that generated the market for Opower. That was the secret of their success.
For us, it took us 7 years since we commercialized the solution in 2018 until the acquisition, which is a very short period of time if you think about utilities and energy and so on. Nevertheless, I would say it's a crazy journey. There is a lot of ups and downs. And I would say you need to have a farmer mentality, which means that you need to look. I know everyone would say it, but you need to go through the journey, and what you will find out that everyone are going through the journey, so it's okay. Don't get too much on yourself on the highs and on the lows, and just continue. That's it. Good luck.
Last one.
I think that it's becoming quite a consensus that compute in space or data centers in space, and the SpaceX IPO is happening next week, I think. It's going to be a major trend. We're now in the midst of making an investment in a company that is exposed to that in a very meaningful way, and that has to do with all the shortages and the political backlash with the data centers, terrestrial data centers. So I think directing your efforts to learning kind of where that is going and what componentry, what type of investments can give you positive exposure to computing space is going to be massive. I think fast forward a couple decades from now, maybe even 1 decade from now, the vast majority of data centers will be extraterrestrial data centers.
Very interesting. Thank you very much to all three of you.